heavy dollar selling continues. It is effectively in free fall mode. Are we going to see some more this week with the big non-farm payrolls in focus, guys? Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So as we head towards the end of the month, the dollar is heading for its third consecutive in the red. Some straight selling has been underway because remember I've told you about those three pillars that are supporting the dollar to the upside. Remember, we had decent economic growth, we had a hawkish FOMC with higher for longer stance, and we also had sticky inflation. But those three key pillars are firmly eroding as data softens. The FOMC have started cutting rates, and obviously inflation has been cooling. So look here, you can see July, August, September, straight selling to the downside there and remaining vulnerable. When you look on the latest week, okay, obviously falling there. We have been doing so pretty consistently, as I say, since July. If you just view this on a daily for the moment, you see how price action was consolidating. We were testing this key sort of 101 area to the downside, and now obviously we've had a breakout and a bit of a retest. And the door is open. As I said to you guys before, the door is open to test 2023 lows. All right, as you can see here, those lows there in July 2023, sub 100, coming into this sort of 99.80 towards 99.50 area. Now, just before we look at data this week, we had late last week, just to put the cherry on top for the greenback, I'm just going to bring up all the data here. Okay, the Fed's preferred measure of inflation, which was core PCE. Okay, so let's go on Friday. Core PCE cooled down to 0.1%, but then also the subcomponents, which is also important to note, personal income. Okay, so the income of consumers coming down to 0.2, lower than expected, lower than previous. Personal spending coming down to 0.2%, lower than expected, lower than previous. So that's disinflationary. We've got income down and also spending down. That's disinflationary. So we're only really, when you look at inflation metrics, really, we should continue to see inflation cooling, all right? Cooling. So that leaves the door open to more action from the FOMC, or at least what markets are expecting. If you look here in November pricing, markets are expected the probability 53.3% that they're going to cut again by 50 basis points. Okay, 25 basis point pricing probability 46%. All right, so that's weighing on the dollar as well. And as I say, we're really locked in on those 2023 lows. Now, if we look at the calendar this week, okay, we've got a number of key data points. This is labor market data week, but let's just jump straight into non-farm payrolls, right? Average hourly earnings expected to cool. Again, that's disinflationary. People getting paid less, that's less potentially people spending, and obviously price of goods and services come down, disinflationary. We've got the non-farm payrolls employment change, 144 jobs, 1,000 jobs being expected to be added to the economy. You can see the numbers on a downward trajectory. We've been cooling these past readings. Okay, the unemployment rate expected to remain steady at 4.2%, but overall, we're expected disinflationary data, which could further weigh on the dollar. And as I say, maybe we're just going to get that last drop down to this 2023 low before potentially we could see that upside, and before that, you know, that risk aversion narrative comes into play where we see safe haven flows. But right now we're trading what we see. Markets are trading at the surface level, and they're thinking about another 50 basis point cut as data worsens, as inflation cools in the United States, and that could take us down to those 2023 lows and allowing some upside for the dollar's peers this week. You can also expect some volatility for the euro this week because we have key inflation data, CPI from Germany and the Eurozone as a whole. And this is important because markets are trying to figure out whether the ECB are going to be cutting rates again, obviously after cutting just recently at the last decision. So they're trying to suss that out. Obviously, if inflation's coming down, it gets us closer and warrants those necessary further rate cuts from the ECB, particularly as data remains vulnerable. The economy is fragile. I said this before, how China and the Eurozone are very fragile economies right now. If we look at the data, the PMIs, just the week before, we observed a massive slowdown in these, okay, across the board. The data is disappointing. Manufacturing PMIs, the German IFO as well. All these data points just disappointing, and just builds the case that we are getting that near a potential recession for the Eurozone, in my opinion, right, with this slowdown in data. So we're going to keep an eye on these CPI figures from Germany. Inflation expected to remain at 0.1% after showing signs of disinflation on a month-on-month reading, last reading. Inflation in the Eurozone expected to cool overall on a year-on-year annualized basis, which would warrant obviously necessary rate cuts. Obviously, if they don't cool, if this data doesn't cool, then it's going to support euro to the upside. Now, obviously on the flip side to the Dixie, one very important thing here is on a monthly, we've cleared very key resistance. Can you see that? around that sort of 110, 30 towards 50 area. Okay, look, resistance, resistance, resistance. We had a breakthrough, left that wick to the upside, and then obviously we've seen that being filled so far in this month of September. So right now, given the fact that we've broken above that key weekly resistance, it does leave the door open to some further potential upside. When you look left here, you know, there's no reason as to why we can't go and challenge, you know, this high, this wick here in July 2023. On the flip side to the Dixie, right? We had the lows there with the Dixie. These are the highs for euro dollar. So we could have every reason to do that as long as the data doesn't cool drastically in terms of inflation. All right. On a weekly, you can just see price action. We're narrowing. We're in consolidation mode. We're waiting for a catalyst to break us out. If we want to continue to the upside, you can see heavy resistance there, protecting that psychological 112. We need to go for a breakout retest, use this as new support, and then we can extend to the upside. Well, you know, maybe not as drastic. We can at least go and challenge these highs of 2023. So keep an eye on this, because allied with what's going on in the dollar as well, this CPI data is critical for shaping up how euro moves moving forward. So we've got to have our fingers on the pulse with the data points on a CPI level for the Eurozone, but also what's going on with the dollar with regards to the labor market data. Focus also on the second largest economy in the world, China, where we've got PMI data. Now, China's in focus because you would have seen last week they announced massive stimulus measures, really focused on extreme rate cuts across the board for China. And the reason being for that is because we're seeing a large slowdown in the economy. Growth is low, but also we're seeing real signs of disinflation. Price of falling of goods and services in China. And the reason for that is because people are just not spending. Okay, people are just not spending money. They're worried to want to take on more debt. And I just think, in my personal opinion here, where we're getting this slowdown and people are just reluctant to spend, just because we're going to go and the authorities are going to lower borrowing costs, do you think that it's really people are going to want to go out and spend still and go and take on more debt, especially if we've got this economic downturn? Okay, sorry, just to make that very clear. China are suffering with a situation where people do not want to take on more debt. They don't want to spend money. So just by lowering costs, I don't think that will want to make them further incentivize them to go and take on more debt anyway. Okay, is my point, just to make that very clear. But anyway, markets like that. We saw stocks in Asia being boosted by that. European stocks were also boosted, and US stocks were boosted by that stimulus announced by Chinese authorities. And also, of course, you got to remember with China, their biggest two-way trading partner, or Australia, New Zealand, make that clear. China is their biggest two-way trading partners. Anything bullish that's going on in China is also bullish for Australia and New Zealand economy. So that actually helped AUD and NZD. If you look at the performance last week with AUD, so on a weekly, very decent performance there. Same with NZD, strong weekly performance there. And that was as a result of that stimulus from China. So this week, we're going to keep an eye on, by the time you've watched this video, it'll be out, but manufacturing PMI. Are we still going to remain in contractory territory? Anything below 50 is contractory territory. And we've seen that for the past few readings. So obviously, if we do get a surprise to the upside, AUD is going to be supported. If it comes out to the downside, we're going to see a little bit of near-term weakness for AUD and NZD. Now, when you look at AUD here, similar to Euro, really strong monthly performance right now, taking advantage of this dollar weakness. Obviously, we've got a hawkish RBA still at the moment. We've taken out quite decent weekly resistance. Can you see here? Let's make that clear. At that 6800 area. So that'll be likely to be new support, as you can see along here. All right, when we've cleared that, we've gone and had a run towards that psychological 170 area. Excuse me, not 170, 7000. So that's the next potential target area for Aussie dollar. We've got a bit of daily resistance. You can just see here, just sort of basic daily resistance around that 68.90 area, just into 6900 effectively. Okay, so as long as we clear this, we can have room to push into that psychological 70 mark. Similar sort of thing with NZD. Okay, on a weekly, cleared a bit of heavy weekly resistance around 6300. Again, psychological area next viewed at around 64. Okay, will be the next sort of area to break down. Okay, as you can see up here in 6400. Same sort of thing on a daily basis. We've just got a bit of near-term resistance here. Okay, at this sort of mid 63 area. We want to break that down, and we can use this new support and go and push in towards sort of 6400. And you know, depending on how much weakness we see in the dollar, obviously this could obviously fly and push in towards sort of 6500 territory, in towards the highs of 2023. I guess sort of similar to Euro. So we've got a lot of highs of 2023 in focus for these dollar pairs. It just depends on how much dollar weakness we get. So again, another week packed with action. Plenty to cut your teeth on this week. Have your finger on the pulse. Other than that, stay lit, stay blessed, and I'll catch you on the next video.